Good morning, everyone, and welcome to today's webinar on construction conditions in the Ninth District. My name is Carmiana Matson. I am the Assistant Vice President of Regional Outreach and Public Programs at the Minneapolis Fed. I'm going to turn it over to our speaker, Ron Wirtz, in just a moment. But first, let me say that this webinar is part of a series of webinars. Ron will talk a little bit more about that, but I put a link in the chat box to the webinar series. We will be following up with each of you next week with an email that will include copies of Ron's slides as well as a link to today's video presentation. At the end of Ron's presentation, he will have a few minutes for Q&A. If you have questions during the presentation, you can submit those via the chat icon at the bottom of your screen. And with that, I'll turn it over to Ron.
Thanks, Carmi. I appreciate the intro, and I really appreciate everyone showing up this morning. You know, with it being March and the weather turning a little bit warmer, I think everyone starts to turn their attention to the, especially for this audience, the construction season for spring and summer, and hopefully greater activity. And I'll have some things to share with that in terms of some hopefully positive signals. Before I get started talking about today's survey, I need to give my disclaimer that the views expressed here are not necessarily mine and not necessarily those of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. So as Carmi mentioned, just real quickly, this rec webinar series from the Minneapolis Fed really springs from our annual survey, conference that we do in January every year. And the idea there is we're really trying to connect people and research on the Ninth District. So we're doing a lot more survey work during the pandemic, and we're going to carry this forward really indefinitely because we're learning so much from it. And as we do and we connect with so many businesses, we're using these webinars really to help disseminate and discuss what businesses are telling us about current conditions, because they really do give us kind of a real-time look at at how businesses are faring in the pandemic. So this is an ongoing series, so you can look for these going forward as well. Before I get started on the survey itself, I want to thank partners, any of you that happen to be listening or people that are watching today that have actually taken this survey. We do this survey through the help of about 40 construction and trade organizations across the Ninth District, including a couple in every district state. You are the ones that help get our surveys out to your construction firm members, and we can't say thank you enough for that help. The idea behind it is it not only gives us information, it helps give you information that you can get to your members as well, and we really appreciate that. I'm always looking for more partners, so if you happen to be an organization that can get our survey out to your members, or you happen to be someone who is part of an association that maybe is not involved, I'll have some contact info at the end, or you can drop me a note in the chat box. I'd be happy to follow up afterwards. So in terms of our pandemic outreach, what I'm going to talk to you about today is just one of several regular quarterly surveys that I just wanted to make people aware of, especially for maybe those that aren't in the construction sector but are interested in learning about our construction survey. Not only this survey, but we also have a hospitality tourism survey that's out in the field right now. We also have 2 general business surveys, and we also do an agricultural credit survey. So again, it's really our intent to really be reaching out to firms to give us a real-time sense for what's happening in the economy. Today's focus is going to be on the construction survey. We did this survey in mid-February. We got more than 500 responses from across the Ninth District. And again, for those that aren't familiar, that includes Western Wisconsin and Michigan's UP, and then Minnesota, the Dakotas, and Montana. And I need to remind everyone that the results here are a snapshot. We don't scientifically sample our respondents, and for that reason, we can't consider this a scientifically valid survey. We think it's a very good snapshot of current conditions right now, but I would ask that you interpret results carefully, and I'll give you a few examples of why we have to be careful about that interpretation as well. So some quick surveys, or excuse me, some quick survey takeaways. You know, we know that winter is normally slower for the construction sector, but the survey right now is suggesting that recent activity has slowed more than usual. We know that rising input costs, this is probably the second theme that really came out of this survey, is that input costs are rising and really hurting firms. However, I am starting to see some better news in a couple of different areas. Requests for proposals were net positive for the first time since the start of the pandemic. Cancellations and delays also seem to be improving, though they are still net negative, but they seem to be maybe moving in a better direction. There's still a lot of hiring going on, even though that recently we've seen some revenue slow down. And insolvency appears very low, and firms in general seem pretty financially stable. So that's also good news. So the first part I want to talk about are the revenue trends. And there's a couple of measures here, but before I get too deep into what the survey is saying, I want to just orient people. So a lot of charts are going to look like this. And in terms of how to read the chart, red means bad, green means good, deeper colors mean more to the poles of either side. So what we did is we asked firms to describe their revenue from the previous 3 months, roughly mid-February, mid-November to mid-February, and we asked them to compare it to 3 different periods. The same period a year ago, which is the top bar, the previous 3 months, which is the middle bar, so roughly the third quarter, and then the expectations for Q1 of this year compared to Q1 of last year. And basically what you see here is that compared to last year, a lot of firms are seeing negative revenue trends. Not particularly surprising, again, because we're in pandemic. But we're also seeing that the revenue compared to the previous 3 months was also negative. Also not terribly surprising given the seasonality effect. But what I would tell you is that compared to our October survey, the number of firms that saw a negative revenue trend was steeper. So in general, what we're seeing is that despite the seasonality, it seems like firms are having a more negative revenue experience recently compared to earlier in the pandemic. The good news is that the future quarter turned around. So we're seeing the future quarter that's close to revenue neutral in terms of how firms responded, and that is a notable improvement from the October survey. So it looks like, and along with some other indicators, it looks like there might be the potential for a bottom, and that things maybe it will improve from here. So let me unpack some of that broader revenue trend because we asked firms to give us some idea of where they're located, what sector they're in, and what type of construction firm they are. So we're going to split out some results by that to give you a little bit more detail. So the first thing I want to say, I give you the chart by state in part because I have partners across every state, and those associations really like to see how the members in their state are doing. So I'm going to offer this chart, but it'll be the only one by state, in part because composition really matters, and I don't get enough responses across the district for me to split out a lot of results by state. So what you see here is, for the most part, things kind of reflect the same general trends. Everyone here is net negative except Wisconsin. Wisconsin's not not net negative, in part because I get a really high housing response from Wisconsin, and housing, as I'll show later, is doing better than other sectors. So the other part is that results from Montana and the Dakotas, I don't get a lot of responses there. It's something that I'm going to have to work on a little bit harder going forward. But we got a small response from those states, so I'd be very careful about taking anything particular from those states in terms of the overall trend there. In general, I think the results here do still show a lot of the same overall pattern that generally results have not been terribly positive. One thing I did just to see if it might offer a little bit more insight, though, is I basically took, because more than half of the respondents are in Minneapolis, St. Paul, in that region. Then decided what might be useful is to offer what the rest of the ninth district looks like. Again, we are comparing a very large geography there. So again, just for another way of kind of looking at the data, what it looks like from the rest of the ninth district is that it does look like those outside of Minneapolis, St. Paul are faring slightly better. I would not call this a particularly positive picture, though, in terms of comparison. Minneapolis, St. Paul does appear to be seeing a little bit more negative experience right now. But as I'll show you here in a couple of slides, it actually looks like Minneapolis, St. Paul might also be seeing some of the rebound. In terms of revenue by sector, we asked them to identify out of those 4 main categories, and it's kind of the same picture. The overall recent revenue trends have been negative across all of the sectors, including residential, which is a shift from the previous survey. But residential is the least negative by a fair margin, especially when you look at how the number of respondents that have seen positive revenue trends. And then commercial and non-residential, similar to the October survey, is the most seeing the most difficulty. But year over year, the year over year trend is more negative across all of the sectors compared to the October survey. Basically, we also asked them to look at or tell us what type of firm they are within the construction continuum there, and it's really the same story. Some are seeing more, firms are seeing a little bit better activity than others, but in general, year over year comparison is basically worse kind of across the board. In terms of cancellations and delays, this is where we start to get into some areas that I think offer a little bit more optimism. So we asked firms to identify both cancellations and delays for public and private projects. And as you can see here, that still continues to plague a lot of projects right now. Cancellations are still prevalent, as are delays. We're seeing them a little bit more in private projects than we are in public projects, but in general, compared to October, we're seeing this category move more to a neutral stance. So it was more firms were seeing more cancellations and delays in the October survey than we're seeing in this survey. So I think that's some good news. So here I'm comparing the sectors, comparing private project cancellations compared to October levels. And again, still prevalent, but it's climbing to neutrality right now compared to the October survey. So we're seeing some improvements there, with all of them fairly close to neutral right now. In terms of the future pipeline, the request for proposals, this to me is probably where I think we see the most optimism. Now, again, I think part of the reason we're seeing a little bit more activity as we are moving into the construction season. Still, the fact that we are seeing RFP levels that appear to be rising, I think is good news regardless. RFPs for Minneapolis and St. Paul firms were net positive for the first time since we've been measuring this during the pandemic. There does still seem to be a little bit of issue in terms of public project RFPs. Those tend to be a little bit more muted, especially for firms outside of Minneapolis, St. Paul. So if you look at the bottom chart there, public project RFPs, those in the Twin Cities seems to be a little bit more active. Those outside the Twin Cities seem to be seeing still a little bit of slowness there. But in terms of private projects, both of those are pretty close to balanced right now, hopefully moving into the much more growing pipeline sentiment moving forward. Excuse me. So then again, from a sectoral standpoint, I think what you see here is that the residential area is still head and shoulders above other sectors in terms of growth of RFPs. So they're still seeing a strong pipeline of new projects, but all of the other sectors in terms of pipelines, in terms of what they are seeing for future projects, all of those got more positive since the October survey. So some other metrics real quickly. This is the other one I think that I mentioned early that we were hearing very strongly through this survey, that firms are seeing big price increases in costs. So here you have the blue-gray line is over the past 12 months. The tan bar expected over the coming 12 months. You're seeing very significant cost increases. We hear this anecdotally, and you guys everyone in the survey told us this very loud and clear, that prices have been rising fairly significantly, roughly 70%. We're seeing costs rise more than 5%. We hear anecdotes, especially for certain products, lumber, steel, things like that, that are way over even 10%. We're hearing, 30, 40, 50% increases in terms of some material costs. I think the unfortunate news is that at least the people that are responding are expecting price increases to even accelerate a little bit more over the coming 12 months. Despite the fact that recent revenue trends have been fairly slow, you're still hiring. And I think that's good news. That shows us that there's still a lot of positive sentiment out there in terms of your expectations. There might be some issues. I think a lot of firms are also looking in part because they have to keep looking because they're having trouble finding labor. But I think the good news, and probably not terribly surprising, that over the coming 6 months, again, as we move into the busier season, it really does look like there's going to be a ramp up in terms of firms looking for additional labor. And I think that's also, again, a sign of spring, summer coming around. But we're kind of hoping that that's a complementary sign to some of the other things that we're seeing in terms of better RFP levels, things of that nature. Again, I kind of alluded to this. We're always interested in whether or not you're able to find labor. This has been a very consistent finding, not only during the pandemic, but even pre-pandemic, or especially pre-pandemic. So you're out there looking and you're having some difficulty finding labor. We're hoping that that turns around again, maybe as the vaccine takes hold and there are fewer issues related to quarantine and lots of other things that are going to kind of unpack or kind of packed inside that. But we're hoping that that labor market really gets better for firms. Wages are also going up, so we're seeing that there is labor demand. You're also having some difficulties, so the natural response I think that we're seeing is that firms are raising wages. We're seeing wage growth that's been fairly persistent even during the pandemic. We're seeing a little bit more for skilled trades. Again, I don't think that's terribly surprising. I think that's where firms are seeing the most difficulty in obtaining labor, but it is also for all other types of jobs as well. And that wage pressure, what firms told us is that they're expecting that wage pressure to increase a little bit more over the coming 12 months as well. Solvency, I think, is also one of the good measures that persistently has come out, especially in the last couple of surveys that we've done, is that we've seen a real ratcheting down of insolvency risk to firms that are responding to us. So only about 5% right now say they couldn't last more than about 3 months under current conditions. This is a small fraction, probably about a quarter of what we see among firms in general, closer to 12, 15% in our other surveys. So in the construction sector, I think there's a lot of financial stability, especially in comparison to other sectors. So real quickly, how do I look at the survey results here, especially in context for maybe others? Right now, firms say recent conditions have been pretty difficult. It's kind of hard to not see what they're telling us in terms of year over year and quarter over quarter comparisons and kind of try to triangulate those. And it seems like they're saying things are getting slower out there. Some of the data suggests that as well. They're really down virtually by any comparison and any cut of the data that I look at. Costs have been increasing significantly. That clearly has also been a problem for firms, but there does seem to be some evidence of a bottom. And I hesitate to use that term, and I want to really qualify it because the next survey you just don't know what's going to happen, especially given a lot of variables that are outside the industry's control with regards to the virus and the vaccine. Things could change, but I do think there are some at least good news in this last survey. Levels of cancellations and delays have improved. And even better news, requests for proposals were net positive for the first time since the start of the pandemic. And we're really seeing strong hiring expectations for the coming 6 months. And I think that also is an indicator that firms, maybe see better activity coming forward. In terms of future tracking, again, this is a quarterly survey now, so we're going to continue doing this. This is really important to the Minneapolis Fed. We hope that it's really important to our partners and members and people that are watching today. We're going to have another construction survey in May, so you can look for that. Again, as I mentioned earlier, I'm always looking to expand partners so I can get a better response, especially in those places that I'm maybe not getting as good a response. For anyone interested, I'm going to offer some contact info at the end. And I would love to hear from anyone that's interested in getting hooked into this particular survey. Before I leave, I wanted to offer a few other resources. So the bank has any number of resources, but two I want to point out. We have an economic dashboard, the COVID-19 9th District Economy Dashboard. I offer a chart here on change in job postings, but there's a lot of real-time data in terms of some consumer habits. We have job postings here, lots of other kinds of measures that you might find interesting, just in terms of kind of getting a sense for what the real-time economy is doing in your state. As you can tell, these are the states that are listed below are you can turn on and off, so you can clean up this survey if you're only, or this chart if you're only looking, say, for North Dakota. But it offers a range of geography and touch points that you can have a better idea of maybe what's happening in your region. And then over on the right, we also have a feature that we call recession in perspective. And basically there are a number of different areas that you can see how the current recession is reacting to previous recessions. Here I have a chart on construction employment by industry, and it compares how that reacted in relation to other recessions in the past. So again, I think there's a lot of resources on our website at minneapolisfed.org that I think you might find interesting that and help you gauge really where we're heading right now. That's the end of my formal remarks. As Carmi had mentioned, I am happy to take a few questions until we get to roughly 9:30, give or take. And Carmi, I'm wondering if there are any questions that have come in for me.
Yeah, there are actually several questions. Let's
Great.
start with pricing of inputs. A couple of questions about that.
Yeah.
First question, how do you see that impacting activity?
Right. That's one thing that I think may be influencing some of the most recent numbers. It's really hard to tease out necessarily. Anytime prices increase, I think the normal expectation is that activity is going to be dampened. So that might be part of the reason why we're seeing some of the recent slower activity levels. In terms of going forward, what is a little bit in contrast is they're expecting higher prices still, but rising activity. So it's one of the things that we're following very closely in terms of seeing what the net impact is. We know there, or at least we think there's some pent up demand and demand that may be willing to absorb those costs. We also might be seeing some change in plans if prices continue to rise. We have heard of, we do get, a fair number of anecdotes in. We are hearing that billers are accepting smaller margins just to keep people busy. We're also hearing that they're having some difficulty passing those prices on. I actually heard an anecdote recently from someone in Montana that says they're likely going to lose money on a couple of projects that they didn't expect to, because contracts were written in such a way that they weren't able to pass a recent price increase onto the final client. And so if that's happening a lot, I think we're likely to see some mixed activity or mixed impact from rising prices. It's definitely a concern, something we're watching closely.
And in terms of pricing expectations, I know you mentioned your survey respondents' pricing expectations. Does the Minneapolis Fed itself have projections for input prices?
No, well, we don't. I mean, we clearly follow inflation very closely, but we don't do any primary data gathering on that. There are lots of other organizations, including in the field itself. The Mortenson Construction Materials Index, I think, is a very useful one. It's one that we watch as well. And frankly, this survey is a really good one for us as well. This is probably the most primary input we have in terms of what's happening with material costs in the industry.
And do you see the higher input costs representing that perhaps there's broader inflation across other industries, or do you think it's isolated to the construction industry?
What I would say is the inflation numbers aren't suggesting, certainly they're having some influence. If we weren't seeing it in the construction sector, I think overall we'd be seeing it a little bit lower. But if you look economy wide, inflation numbers are not even to our 2% target. Whether or not that continues is something obviously that we follow very, very closely. But again, because not a lot of people are buying lumber, not a lot of people are buying the reinforced steel that's necessary for construction. Again, as some of those markets maybe spill into others, we'll be looking at whether or not that's influencing overall activity and overall price levels. But right now, it doesn't seem to be influencing overall price levels significantly.
Thank you. Let me take a look at the chat box. Lots of questions coming in. Let's ask about lead times. Do you ask survey respondents about lead times? Are you hearing anything about extended lead times for acquiring inputs?
As a matter of fact, we don't. That's a really good point. We don't. We're always sensitive about surveys that are too long, frankly. That is, I think, a very good question, and that's probably something I'm going to take to my partners, that if they're interested in that, if that's a piece of information that they would find useful, it's certainly something that the Minneapolis Fed would find useful. So it's something that I'll probably have to look at in the future, but we don't ask that right now.
Thank you. We have a question here from an attendee who says that they have heard that the number of bids on RFPs has increased sharply while pricing has decreased sharply. Have you seen any of that or heard any of that?
Yeah, as a matter of fact, we do ask about that. We do ask about the number of bidders that people see in RFPs, and we have consistently seen since the start of the pandemic a much greater level of competition for bids that are out there. And we don't ask about pricing right now, but we are hearing anecdotally from a lot of comments that people leave us that, as you would expect, more competitors means margins, that there's a lot of pricing pressure on those RFPs. So we're hearing that people are really low bidding, again, to keep people busy.
Question about the commercial real estate market. Seems it's quite volatile with office sector being low, hotel sector being low. Can you comment on any anomalies specific to CRE?
Well, we don't ask really any CRE related questions in this. You know, I know a little bit about that sector, and I think office and retail are continuing to see some pressure. Industrial space, I think, is really comparatively very healthy, including in the construction, the new construction area. But in general, I think that's one of the reasons that we're seeing a slowdown in CRE in Minneapolis. I think is evident in some of the numbers that we're seeing in terms of, you know, commercial activity. So as I think things recover, I do see that space probably seeing hopefully more pickup activity right now because things have been slower in that area and in Minneapolis.
And switching over to residential construction, do you think higher mortgage rates are going to put a damper on residential construction?
I don't think there's any question, you know, higher prices generally dampen whatever activity it is we're talking about. So if mortgage rates increase, I think that is likely to have, you know, some downward pressure on overall activity. In terms of rates, if they are going to increase, they are still going to be historically comparatively low. The Fed has been has communicated very consistently that we don't, from our end, we don't see interest rates rising. We don't see the Fed funds rate rising potentially for some time. And I think we'll be patient on any increases. So, you know, to the extent that the variations between a quarter point here and there, you know, depending on lenders and things like that, I don't see having a dramatic effect on kind of putting a lid on what is generally a strong residential market right now.
Let's switch over for a couple questions about workforce. What skills are construction companies finding most difficult to attract or in short supply?
Yeah, I can only tell you this, you know, more anecdotally because we don't ask that specific question, in part because we ask a lot of different kinds of firms and we'd have to put in too many occupations. In terms of on-site, we hear, I think the skilled trades have always been in short supply, but we do hear from really all kinds of firms about some component in their firm that they may be having trouble finding, at least at the prices or the wages that they're hoping to offer, whether it be, you know, an architect or a plumber or a welder or a general laborer even. So we're really hearing it kind of across the board, but for the most part, what I hear most consistently is really any of the skilled trades.
Are you seeing any wage inflation in those areas?
Oh, I don't think there's any question. You know, I think the survey showed that there really is, you know, and I hate to call, you know, I don't know what's too much. You know, for the most part, what you see is there's about a third of respondents that are saying wages are increasing about 3% or more. Historically, that's not particularly strong. It just happens to maybe feel strong in the previous history of, or the recent history of wage increases. Historically, above 3%, 3% is about average. So the fact that only a third of firms responded that they're raising wages more than 3%, sure, it doesn't feel great for those firms, and that's stronger than other sectors that I follow and that I survey. So I'm seeing the most wage growth in construction. But again, there still are a lot of firms that have not been able to raise wages a lot, and that might be part of the reason that they're struggling to actually find labor.
Great, thanks, Ron. That's all the questions that we have time for today. As we mentioned earlier, we will be sending a follow-up email to all registered attendees next week with a link to this video, as well as a link to Ron's slides and some of the other resources that he mentioned in his presentation. We will keep you posted about future events in this webinar series. Thanks so much for joining us.
Thank you.